In this video, I'm going to discuss my choice for this year's Stocks and Shares ISA and talk through why I chose Trading 212, what I've chosen to invest in, and I'm going to explain my investment strategy for the next year or so. I recently made a video which compared different investment platforms, where I concluded that Trading 212 would be my investment platform of choice for the coming year to hold my ISA. Some of the main reasons for this were that, firstly, Trading 212 does not charge any platform fees for holding your investments. Trading 212 do impose charges for foreign exchange transactions, but these are easily avoidable. And the other main reason for me choosing Trading 212 for this year's Stocks and Shares ISA is that they are currently offering 5.2% interest on cash you hold in that account, meaning that you can earn 5.2% on any of the cash in your account which is yet to be invested. For me, this was a big plus, as I wanted to deposit a big amount into my Stocks and Shares ISA as early as possible after the new tax year has started, to maximise my time investing or saving tax-free. But I didn't want to invest it all in one go. Investment platforms have cash accounts that sit alongside your investment portfolios. This is a place where you can hold money short term and then easily transfer it into the investments of choice as and when you're ready to do so. Most of these cash accounts offer some sort of interest rate, but generally it's a lot lower than what you would get with a high street bank, for instance, in a cash ISA. But Trading 212 is currently offering 5.2% interest on this cash, and this is really competitive when you compare that with what's on offer in the high street. And this means I can have the best of both worlds, treating the cash account as a savings account but then transferring it over to the investments as it suits me. Whether you're cautious like me or more adventurous, it doesn't matter. This video will have something in it for everyone. And as you watch this, you'll understand my thought processes for the choices I've made as I talk you through the steps of opening a Stocks and Shares ISA with Trading 212, selecting investments, and the reasons why I've chosen what I've chosen. I make these choices, hopefully, as a sensible amateur investor, and anything I say on this channel is for financial education purposes and should not be construed as financial advice. Please fact check anything that I say here and what anyone else tells you on YouTube, and seek the advice of a suitably qualified professional if you're unsure of anything. So let's move on to the first step, how you open an account. For me, this was a little easier as I already have a general investment account with Trading 212, so my identification was already verified. If you are opening an ISA with Trading 212 for the first time, you must be a UK resident and over the age of 18. And Trading 212 will require certain documents from you for identification purposes. The first will be photographic ID and a selfie of you holding your identification. The second, your national insurance number, and the third being proof of address. Just something to be a little bit aware of when you're opening accounts with Trading 212. There are three options for you to choose from. One is a general investment account. Two is a Stocks and Shares ISA, which is what we're talking about in this video. But there is another option called CFD, which is contract for difference. Contract for difference, in my opinion, is not for amateur investors, and we won't be talking about that during this video. A general investment account will allow you to do the same things as a Stocks and Shares ISA will do. However, you don't get the tax-efficient benefits that the ISA offers. In any tax year, you can contribute £20,000 to your Stocks and Shares ISA. I already have a general investment account with Trading 212, but I'm not going to be transferring those funds into my Stocks and Shares ISA, as at the moment in that account, I have capital gains and dividend allowances which aren't being reached. However, next year I will review this and see where we are. I've already transferred £20,000 into my Trading 212 ISA. I was happy to do it in one go because I've already tested the process previously with my general investment account. If I had been doing this for the first time, maybe I would have transferred in £1,000 first, just because I'm cautious and I want to test the process. But you might think that that's unnecessary. You have various options for transferring into Trading 212. You can do it by direct transfer from your bank to Trading 212. They give you a bank account number, a sort code and a reference number. You can also do it by faster transfer. Trading 212 use a process called TrueLayer. I've not used this, but I've read reviews which suggest that it is safe. The third option is that you can transfer money in by using Google Pay or by using your debit card. If you choose this option, you have a ceiling of £2,000. Thereafter, you'll charge 0.7% per transaction. I'm seeking to get the maximum amount into my Trading 212 account as early as possible so I can start earning interest straight away, whilst my funds remain uninvested, rather than them being outside of that ISA and therefore taxable. But with Trading 212 and that cash, you won't automatically start earning that interest. You have to opt in for it. Once you opt in, Trading 212 will then invest that money in qualified money market funds and or cash deposits, which are probably the next safest option to bank savings accounts. They are not for everyone though, and your capital is still at risk, albeit a small one, from investing in such funds. These money market funds entail the fund manager investing in short-dated government bonds and short-term fixed-rate bank deposit accounts, amongst other short-dated instruments. Although cautious, I'm happy with this low risk. that returns me 5.2% interest. If there were much higher cash savings accounts available on the high street, then maybe I will put my money there and then transfer those funds into my Trading 212 stocks and shares ISA during the year. It's just easier this way for me now with that higher interest rate because I've got the funds readily available to transfer over to investments as it suits me. As we're talking about money market funds, it's best that we discuss some of the risks. The first, I guess, is an obvious one, and that's interest rate risk. Interest rates could fall. In those circumstances for me, I then might look to move my money. There are other risks such as credit risk, where the issuers of these bonds or these short-dated bank deposits, which are loans from you to them, default on them. Or there is liquidity risk, where there's a delay in you getting access to your money due to a high demand from other people wanting to make withdrawals. This is unusual, but it might happen during a stock market crash where people start to panic. You don't have to deposit £20,000 in one go, by the way. It's just what I've chosen to do. Once you deposit any amount into your stocks and shares ISA and click the earn interest button, any money thereafter will also default to the same option. That £20,000 I've deposited into my stocks and shares ISA is earning me about £2.77 per day in interest. Trading 212 are also offering 1% cash back on any money that you deposit into your ISA account during this financial year. That recent deposit I made into my stocks and shares ISA gave me £200 that got paid into my general investing account. One thing of note regarding this 1% cashback option, the offer is only open until the 30th of April 2024, and to get it, you'll need to open a stocks and shares ISA with Trading 212 before that date. But once your account is open, that cashback offer applies for the remainder of the financial year. Trading 212 is regulated by the Financial Conduct Authority and has FSCS protection, meaning that you would get up to £85,000 back should the platform fail. But that doesn't mean that you would get back that money because of poorly performing investments. So please make sure that you understand this before investing. If you decided to take the earn interest option and your money was then invested into a qualified money market fund, as discussed earlier, there is a chance that that fund could perform poorly, and in those circumstances, FSCS protection would not apply. Whereas putting your money in a cash ISA savings account with a bank would. So this should be a consideration for you if you just want cash savings. You should not confuse money market funds with cash savings accounts as they are different. Trading 212 has a really intuitive way of you understanding the proportions of your investments by means of pie charts. Once you've chosen the option of creating a pie, and I think this would be a good option for you as a beginner investor because of the simplicity of it, you can either copy other people's pies that are published within the community on Trading 212, or you can choose your own by trawling through the list of investments that are on Trading 212 and then selecting what you want. Once you've selected what you want, you can then select the percentages for each one and your pie is then created. You then decide whether you want to manually invest or auto-invest. Auto-investment means that you just set up a date and an amount and your funds then get invested automatically. But, as mentioned earlier, you can use TrueLayer to set up a direct deposit from your current account if that's what you want to do. Alternatively, you'd have to do this manually by that direct debit card or the Google Pay option, or by manually transferring money from your current account into your Trading 212 account. And once that money then gets into your account, you then transfer it into your pie. Whether you do this automatically or manually, Trading 212 will purchase the investment in the percentages that you've set. There is also an option to rebalance to keep the percentages of your portfolio the same as what you set originally. And this is useful if, for instance, one of your assets starts performing better than others and becomes a higher percentage in your portfolio. But I wouldn't be doing this every week, maybe just rebalance once per year. I hope that this video has been enjoyable and useful to you so far. If you do enjoy the content, then please could you consider liking it. That will then tell YouTube that the content is okay for others to watch. And if you've been here before, thanks very much for coming back. But if you are new to my channel, please consider subscribing to it and to turn on your notifications so you will know when I've posted new content. As you can see from my pie, I have chosen a more cautious portfolio which consists of 57% in the Vanguard FTSE Developed World ETF, 3% in the Vanguard FTSE Emerging Markets ETF. Emerging Markets gives me a little exposure to countries such as China and India, so well worth including in my opinion. And 40% is in the Vanguard Global Aggregate Bonds ETF. This pie is calculated to give me returns in the region of 9% annually according to Trading 212, but you should not rely on these estimates as these could turn out to be wrong. When it comes to choosing what investment might be right for you, I've recently made a video which talks about 7 of the best Vanguard funds. I've decided to invest in the emerging markets and developed world separate, even though there are global options such as the Vanguard FTSE All Cap or the Vanguard FTSE All World, which include them both. I like keeping them separate because it means I can change the proportions of the emerging market, which is currently about 10% of those global funds I mentioned. Also, it seems cheaper to get exposure to emerging markets this way, given that it's only going to be 3% of my portfolio that is charged at 0.22%. I then also pay a much cheaper ongoing charge figure in the developed world fund of 0.12%, which would be on 57% of my portfolio, and 0.1% on the global aggregate bond funds, which is 40% of my portfolio. If I invested in those global funds I mentioned, then I would get charged either 0.22% or 0.23% on 60% of my portfolio. The ongoing charge figure, OCF, is the fee that the fund manager imposes for administration of that fund. Even with zero platform fees, which is what you get with trading 2 and 2, you still have to pay this ongoing charge figure when you purchase a fund. So it's worth shopping around. And I know that the figures are quite small when you compare the global funds with the way I'm looking to do it. However, my fees are smaller and that could make a difference over time. You can't control lots of things in investing, but one of the things you can control is your fees. You'll probably note that I have not chosen to invest in specific company shares, even though trading 2 and 2 does give you the option to do so. And I've chosen 3 passive funds that just track an index. This reduces costs, and it also means that I don't have to pick individual company shares and worry about buying and selling when the time is right, as my choice of funds pick everything in the index that they follow. Having less decisions to make is better, right? The more that I normally have to make, the greater the chance of me messing up, and I'm pretty good at messing up generally. I keep costs low by investing this way, by diversifying and investing in hundreds or even thousands of stocks, shares and bonds that are contained within those funds, rather than trying to do it individually with a few. As an example of this, we can look at the FTSE Developed World Index ETF, that is 57% of my portfolio. As can be seen, the fund invests in 2,133 companies across the developed world. That includes the USA, Europe, the UK and parts of Asia such as Japan and Korea. The top 10 companies come from the US, with the largest shares in Microsoft and Apple. So I am actually invested in individual companies, but these are all wrapped together in one pooled instrument, where each company makes up a component piece in accordance with their size. To bring things into perspective, if you delve into the fund's data pages, you will see that from looking at the top 10 companies, that you are still a shareholder in some very well-known businesses if you invest in index funds, rather than in those companies individually. Diversifying in these passive index funds seems a whole lot more sensible and less risky to me than to be an active investor and to have to pick stocks for myself or to pay someone else to do it for me. By being a passive investor, I now don't have to worry about specific companies doing badly, failing and me losing some or all of my money. But that's just my opinion. You might have a fantastic master plan that brings you great returns. Good luck to you if that's the case. You will note from looking at my pie that I have 40% invested in bonds in the Vanguard Global Aggregate Bond ETF. The main reason for this is that I am a cautious investor and I want to have an asset class alongside my equities that is a little less volatile, meaning that I should get less severe price movement in my portfolio, and that means less stress for me. The equity part of my portfolio can be used to generate the growth, and the bonds can then be used as a risk mitigation measure while still providing a real return better than cash. Bonds are said to be generally negatively correlated with equities. This means that when equity prices fall, bond prices will go in the opposite direction or will not fall as sharply, helping you to reduce price drops in your portfolio in the short term and to reduce volatility overall. Adding bond funds to your portfolio might therefore reduce price volatility risk and give you a more stable investing journey, which might be better for a cautious investor, or for someone closer to retirement who wants to draw on their pension pot and does not want to see large drops in their investments at a time when they're drawing their income. But you must also accept that if you do invest in bond funds, just as you reduce the risk, you also reduce the return. That said, my portfolio is still estimated to give me 9% returns per year, even with 40% bonds in the portfolio, so that's good enough for me. You can play with the proportion of bonds that you choose for your portfolio to add or take away risk. Maybe this is something that you should do when you're considering what return you want. I have chosen to invest £500 per month across my pie's proportions for now. I did this as I did not want to invest it all in one go. Imagine how it would feel if I made that £20,000 investment and the market crashed the next day. Yes, I know that markets recover eventually, often very quickly, but I just did not want to give myself any excuse for realising my assets early and selling them at a discount. To be successful, I know I just need to hold on to these things in the long term, keep on regularly investing and letting the market do the work. That's why I've chosen my £500 investment strategy. This will allow me to drip feed money into my investments over a longer period of time. You might decide that purchasing your investment in one go or in larger amounts might work better for you. As it's all invested sooner, you're in the market for longer, giving yourself more time for your assets to compound. And I might change my strategy by making larger purchases if interest rates drop significantly, and I then feel it's worth shifting that money towards equities or bonds, rather than keeping my uninvested funds in money market funds with trading 2 and 2, with the then lower interest rates on offer. The main thing for me though is I'm going to continue to invest regularly using dollar cost averaging to purchase my investments. Dollar cost averaging means that sometimes I'll be purchasing my investments at a discount and sometimes they'll be expensive. But over time, I will hopefully get an average purchase price which is much lower than the current market value. We shall see what happens as the year unfolds, as I intend to publish update videos on my portfolio. Well, I do hope that this video has been useful to you, whether you're a cautious or more adventurous investor. If you did enjoy it, then please consider liking it and subscribing to the channel. And thanks very much for watching.